Hello everybody, and welcome to a very interesting webinar. My name is Dan Valko and I'm Naïve Bayes Marketing Director. More and more people are talking about machine learning. I did a Google search today and it gave me back 61,700,000 hits. It's a big number. In 1 year the number will easily double, even triple. What is machine learning? How can it be used in trading and investing? Will machine learning be part of everyone's trading soon? What do we need to know as a starter kit about machine learning? Dr. Bandi, as usual, will offer answers to these questions and more. Don't forget, we have questions and answers at the end. You may type the questions during the webinar and he will address them at the end of the webinar. Enjoy the webinar. Thank you very much for your time again. So now I will give the control to Dr. Bandi and he will soon start his interesting presentation.
Well, thank you, Dan. Good morning. And thanks to the IFTA for this opportunity to present a webinar on trading system development using machine learning. This presentation focuses on the difference in trading system development when you switch from a trading system development platform to machine learning. And last month I gave a presentation based on trading system development platform. It has been recorded and posted to YouTube. There's a link here. I recommend that you watch that for comparison. Some of the key points in today's presentation are first a brief review and background, and we'll go over that pretty quickly. We'll compare machine learning with traditional trading system development. We'll do a little on machine learning without trading, a classification example using the IRIS database, and then a short discussion of considerations for machine learning for trading. Dealing with stationarity and risk are very important. I recommend that you watch the 2 videos that have been recorded and posted to YouTube, the importance of being stationary and the 4 faces of risk. And I'll assume that you have that knowledge or that you'll go back and get it if it's missing in your experience. Machine learning operates at the confluence of computer science, artificial intelligence, mathematics, statistics, modeling, and simulation. In operation, sets of data, and they're usually large sets, are examined, hoping to detect patterns and associations. Models are constructed with little guidance from the operator, from which generalizations about yet unseen data can be developed and predictions made. Our application is to trading, and that adds the complexity related to time series, non-stationarity, and the techniques of trading. The 2 development platforms produce equivalent systems. Machine learning aside, trading systems developed using AmiBroker or any other trading system development platform can be translated into a general purpose language such as Python. And I demonstrated that in detail in my quantitative technical analysis book. There's a reference to that book and to others later on. One of the points is I do not recommend changing platforms without improving some aspect of the system, in particular its profitability. Technical analysis is based on pattern recognition. As you move from subjective evaluation to machine learning, the mathematics becomes much more evident. Mathematics in terms of solution of equations, such as regression, and mathematics in terms of iterative searches, such as neural networks. There are many machine learning techniques. They're typically implemented as independent procedures with a common interface stored in libraries and callable from the general purpose programs. What I will talk about and recommend is Python using the scikit-learn library. If you're interested in neural networks, you'll want to add the PyBrain library as well. Well, why bother doing this? There is a learning curve, and you give up a familiar development process, and you have to learn a new one. How do you decide whether the effort is worthwhile? To my mind, there's only one reason, and that's that the profitability in a risk-normalized measurement for machine learning systems, or anything new that you would do, must be at least as high as for trading system development platform systems. Several things are different as you move to machine learning. The development platform changes, for example, from AmiBroker to Python. We'll replace impulse signals with state signals, and we'll see a little bit of discussion of those in a slide or two. Importantly, the trading system, as it is typically thought of, disappears. The buy signal and the sell signal go away. Each data point must be self-contained, no reference to other data points. And the model changes from decision tree, which is the primary model for trading system development platforms, to any of 20 or more models in machine learning, and that includes decision trees. One of the advantages of machine learning is you do not have to decide on the rules for yourself, and since you're giving up the development platform, you may have to program a trading simulator and the accounting reports yourself. What stays the same is the input, price and volume data series, indicators such as RSI or Z-score, or candle patterns, the output, the trade list, and the metrics to maximize risk-normalized compound annual rate of return. The trading system development platform has built-in support. You may need to program these yourself, such as indicator calculation, graphical display, reference to prior signals, and so forth. And until a trading system development platform that supports machine learning becomes available, we have to provide these capabilities ourselves. And that means programming a trading simulator. If you decide you need these functions, and as you gain more experience with machine learning, you may find out that you don't need some of them. These are some of the things that you'll have to program yourself into a trading simulator. The development platform knows about buy and sell signals, profit and loss, account balance, slippage, commission, and metrics, and you need to provide those. If you're going to program a trading system simulator for machine learning, I recommend that you begin with the target and how you would trade it, and draw some diagrams about what states are possible, what state transitions take place under what circumstances, and then replicate the accounting and the metrics. Just as a refresher, the premise of technical analysis: the markets are not completely efficient. There is information, patterns, in the historical price series that can be used to identify profitable trading opportunities. Trading systems can be designed to recognize the patterns and to give buy and sell signals. And patterns similar to those found in the historical data will continue to be found in the future data. I believe that traders have a near universal goal, and that goal is for the trader to have confidence that the signals generated by the trading system precede trades that provide rewards adequate to compensate for the risk. The key word is confidence. The primary limitation is risk. Confidence, measurable confidence, comes from following the scientific method, performing out-of-sample testing, using lots of data, measuring results and computing statistics, using the entire distribution of results rather than a single metric such as mean, and using Monte Carlo analysis to analyze what the probabilities are of values other than the mean. The scientific method is pretty well described in the literature. It's a series of steps. State the problem or ask a question, observe data, perform research, form a hypothesis, perform experiments, analyze results of experiments, draw a conclusion, and use the results to make predictions. Each trader has a personal risk tolerance, and the risk tolerance that I use, it's pretty much my own and one that I use as reference in my writings and presentations, goes something like this. I'm trading a $100,000 account and forecasting 2 years into the future. I want to hold the risk of a drawdown greater than 20% to a chance of 5% or less. And what we're referring to in drawdown is a loss of account equity from the highest value to date. You definitely need to switch from impulse signals to state signals. Impulse signals are buy, sell, short, cover. They mark the beginning and the end of trades. There may be several days apart, lasting for trades that are lasting more than 1 day, and there will be a few complete trades per evaluation period. The corresponding state signals are, for example, to be long or to be flat or to be short. They identify the position to be held for the next period. I recommend mark-to-market daily, a signal for every day, and that gives an opportunity to manage every day. And here's the relationship conceptually between the impulse signals. You see on the bottom line the up arrow and the down arrow for buy and sell. And for the period beginning with the buy and until the sell, the state is to be long, otherwise it is to be flat. As a side benefit from changing from impulse to state signals, you get daily trade management. You're going to be computing a state every day, and you get to manage your trade every day. That's the end of the review, and we'll go on to machine learning. We'll begin with a comparison of machine learning with traditional trading system development. There are two ways of viewing the relationship: as an indicator followed by what happens later, or by the target that you're trying to predict and then examination of what happened earlier. This is a flowchart or a schematic of the parts of system development, and the part in the red oval is the part that changes. You'll see the column on the left related to development and the column on the right related to trading. The development is to come up with an idea and some data, and then build a model, backtest it, adjust rules, adjust logic, adjust parameters, test it, backtesting. If it's promising, pass it on to validation, and if it passes validation, pass it on to trading. There are two equivalent development paths. We see the part in the red oval as the two choices being indicator-based or machine learning-based. And you'll see it starts the same, trading system idea, issue selection and data preparation, and it ends the same with a set of trades that are the best estimate of future performance. And within the red oval, we take either the indicator-based development or the machine learning development path. This is the schematic of a traditional trading system. It is a system, and systems are models plus data. The model is data preparation, alignment, transformations, indicators, and so forth, and the generation of signals, and these signals are buy and sell. The data comes as input from the open, high, low, close of the issue being traded and whatever auxiliary data is used, and the output is a trade list. Note the red oval, because as we go to a machine learning trading system, that's the only part that changes. It goes from signal generation to state prediction, and the states are be long, be flat, or be short. We see the same things going on in data preparation, alignment, and transformation, and we see the data being the same. Open, high, low, close coming in, and a trade list coming out. We'll start with a discussion of machine learning independent of trading. And I recommend Python as the machine learning platform. Python is open source and free, as are the libraries needed for trading system development. There are several Python implementations, several of them are free. Anaconda Spider is one that I've used for a lot of my work. I believe it's a good choice. You can download it from the Anaconda website. You will find that Python comes in two versions, version 3 and version 2. Version 3 has been around for about 5 years, but not all of the libraries that are used, particularly some of those for machine learning, have been converted to work with version 3. So I recommend that you take the most recent stable version of Python 2, that's currently 2.7, and install and use it. The installation from Anaconda Spider will include Python, a numerical package called NumPy, a scientific package called SciPy, Pandas, which is the library that does alignment and use of time series, Matplotlib, which is a display of graphical information, and importantly, scikit-learn, which is the machine learning library. There are several references that I recommend for learning Python. If you're looking for a book, Alan Downey's book, Think Python, is a good one to start with. There are some others listed here, and there are many websites. Some of the websites are complete documentation, others are tutorials. Machine learning comes in two different, I want to call them categories. They are supervised and unsupervised, and within that, there's classification and regression. Classification is used when the labels consist of a finite set of values, and most of our market models are classification, where the target will be one of the three states, to be long, to be flat, or to be short. Estimation or regression is where the target is a numeric value in a continuous range. Supervised means that we know the target in advance and we provide that to the learning algorithm for use during model development. There is also a type of machine learning called unsupervised. Unsupervised learning is used to determine structure within an unlabeled set of data. The target is not provided to the learning system, and the typical use is cluster analysis, and it's used to find groupings within a set of data. Unsupervised learning is seldom used for trading systems. There are many references for machine learning. The first one is particularly good. Dr. Abu Mustafa is a university professor. His book, along with his colleagues, Learning from Data, gives a good introduction to machine learning. And you'll read others, some of them related to data science, which is the processing of data to provide information, and some of them machine learning, a little bit more theoretical, that talk about some of the techniques and in some cases the mathematics involved. And there are several websites as well: Wikipedia, Coursera, in machine learning and a Udacity in machine learning. All of the references that we've referred to above deal only with stationary data. As with trading system development platforms, we must take these features into account as we develop our models. Our data is not stationary, we're dealing with time series, and we need out-of-sample validation. This is the machine learning process. Our goal is to use supervised learning to identify the classification of the signal state for the next trading day. As an example, we'll begin with analysis of the well-known iris data. We begin by defining the target we want to predict. For a multi-class problem, we can decompose the target into a series of binary problems, and we're going to be most interested in one class. So we will call it the positive class, and we will give it a numeric value of +1. Everything else is the negative class, and it will be given a numeric value of -1. These can just as easily be thought of as labels, +1 and -1. Because what we're trying to do is take the target space where the pluses are the positive class and the minuses are the negative class, and we're trying to come up with a mathematical equation that defines a decision boundary. All of machine learning classification is based on finding a mathematical description of the decision boundary that best divides the target space. You'll see that it isn't perfect and it isn't straight. That some of the pluses are on the wrong side and some of the minuses are on the wrong side, and we describe those as being misclassified. In general, it is difficult to impossible to get perfect classification, and our concern is to get the best classification we can, keeping in mind the costs of the various misclassified data points. In order to predict the target, we need to have some variables that have some characteristics of them that are related to the target. Most of our time will be spent searching for and working with data that accurately predicts the target. The data is pre-processed and it's transformed, and all of the data points are independent of all other data points, or at least quasi-independent. Each data point must be complete and it cannot refer to previous data. Supervised learning consists of learning the relationship between two data sets, the set of observed predictor value, capital X, and the set of associated known target values, lowercase y, that we are trying to predict. All supervised estimators in scikit-learn, that means all machine learning models, implement a fit XY method to fit the model and a predict X method that returns the predicted labels. Since there's a common calling interface, it's easy to try out a variety of models. The data looks very much like a spreadsheet. The model is defined by the A matrix. We've got a number of rows. Each row is a data point. In a number of columns, the predictor variables form an array on the left-hand side, capital X, and the associated target, Y, is presented in the column on the right. And we're going to solve the equation, which written in matrix format is AX equals Y. The A matrix contains the coefficients of the solution. One of the things we'll do is split the data into 4 parts. We want to split training and testing, and we want to split predictor and target. So from the single spreadsheet on the left, which is all of the iris data, we're going to create predictor variables to train and their associated targets, predictor variables for testing and their associated targets, and we'll use these 4 independent files as we do the training and then the evaluation. The model fitting is the learning part. We're going to learn using the training data. The correct or known value for the target is provided, and that's in the yTrain variable. So the predictor variables and the target are fed into the machine learning fitting procedure, and the results from that are the A matrix. Once we have an A matrix, we can apply that to any test data that has the same form as the training data. So we use the A matrix to predict the target for some out-of-sample data. And then we compare the values that were predicted for the out-of-sample with the values that we knew in advance for the out-of-sample, and the model analysis procedure creates a confusion matrix, which is a common way of evaluating machine learning supervised models. What we're asking is, do the target values agree? We've got, for a given data point, a series of predictor values. We apply the model. We know what the actual target is, and we compute what the predicted target is. We want those two to agree. When the 2 targets do not agree, we have a misclassification, and that's represented by off-diagonal confusion matrix entries. The confusion matrix is a standard for evaluating machine learning classification. Correct entries are true positive and true negative, and they are on the main diagonal. Errors are false negative and false positive, and they are off diagonal. The costs of the errors depend on the problem being solved. This is a standard method, a standard format for presenting the confusion matrix. The columns are predicted, positive and negative. The rows are actual, positive and negative. If there's an actual gain coming and we predicted there would be a gain coming, it will be an entry in the upper left-hand box of the matrix, and it will be a true positive, and that's a good thing. You can see as we've got misclassification, the one in the upper right is called a false negative. It is falsely predicted to be negative. That means that the model said we were going to be flat, but in fact there is a gain ahead. That particular misclassification is a loss of opportunity. In the lower left hand, there's a false positive. The model predicted there was going to be a gain ahead, a positive, and it was actually a loss ahead, and that's a negative, and that's a loss of real money. One of the validation procedures that's used in machine learning is called cross-validation. And I've described it here as taking an original set of data, and this is referring now to the rows that are in the spreadsheet, and dividing those rows into 5 partitions, and I've labeled them A, B, C, D, and E. The cross-validation selects one of those partitions and reserves it to be out-of-sample data, and it uses the other 4 to learn the relationship, and then does a test on the out-of-sample. makes another run with a different out-of-sample, and so forth until each of the 5 partitions has been used as out-of-sample, and in each case the remaining 4 partitions are used to build the model. Now, in order for this to work, the model must be stationary across all of those 5 partitions. We'll start with a classical example, iris. And this comes from the mid-1900s. The data is 150 flowers representing 3 species, and for each iris species there are 4 measurements: the length and width of the petal and the length and width of the sepal. There are 150 rows. Each row has 4 predictor variables: the sepal length and width, the petal length and width, and it has 1 target variable. In this case it's the label of the species, setosa, versicolor, or virginica. If we look at each of the pairwise plots of the predictor variables, sepal length versus sepal width is the one in the upper left-hand corner, and the species are identified by colored icons on the screen. We can see that throughout those 6 plots, and those are all combinations of one against another of the predictor variables, that the red dots separate pretty easily. What we're going to do as we read the data into Python is have 150 data rows, each one of which is 4 predictor variables and a target variable. Now we've got a choice of several different models available. So these are all supervised classification models, and they're ones that you might use as you're trying to develop machine learning for trading. The first is decision tree, and decision tree is the model that's used by trading system development platforms. Ensemble methods means use a number of weak learners. Hopefully they will use the wisdom of the crowds and develop a strong model together. Logistic regression, Naïve Bayes, nearest neighbor, neural networks, and support vector machines. And there are short descriptions of some of these that follow. There are many more supervised classification learning algorithms, and the scikit-learn library and the reference material that we looked at will give more information about those. Decision tree is what's used by the trading system development platform. It's an if-then-else structure, and it is often nested. For example, if z-score is less than 0, then be long, otherwise be flat. Decision trees require very little data preparation. And by data preparation, I mean normalization or standardization. And the feature selection is built into the algorithm. Traditional trading systems are decision trees. And here's how decision trees look when applied to the iris data. You'll see that all 3 of the categories are being predicted. And notice the part that's in blue. If we take the second or third on the top line or any of the bottom line, we can see that a straight line separates out setosa, but that no straight line separates versicolor from virginica. If we run the decision tree model, and I've set the problem up so that all we're trying to do is isolate versicolor from virginica, we see that there's a misclassification of 16 data points. Now this is 50 out-of-sample data points, 10 runs each, so a total of 500 data test points. 162 of them are true positives, and 322 are true negatives, and 16 are mistakes. If we use the ensemble methods, and you can see the 4 columns are ensemble based on decision tree, random forest, extra trees, and AdaBoost, that most of those lines are straight lines, and you can see that the areas on the chart that identify which category or which classification the iris flower falls into are fairly well defined but not necessarily rectangular. One of the ones that you will probably use, one of the machine learning models, is the ensemble model called AdaBoost. And it's a strong classification model that's based on an ensemble of weak-based learning. It's very much like the popular book called Wisdom of the Crowds, where we ask people who are not necessarily expert in an area to make an estimate and then look at the distribution of all of those people and make an overall decision. The way this works is to fit a model and note the accuracy and update the weight distribution of the data points that are being fit, increasing the weight of the misclassified examples and trying again, and continuing until some stopping criteria has been met. For AdaBoost, you'll see that there are 25 off-diagonal or misclassified entries. And for random forest, there are 32. Logistic regression estimates the probability of the class of the target using a logistic function, and that's the S-shaped function that looks like softmax if you've read my mean reversion book. And note that there are 10 off-diagonal elements, and this is how logistic regression identifies the boundaries between the 3 categories. They are straight lines in this case, but they are not perpendicular to the axes. Naïve Bayes applies Bayes' theorem to the data points, and it returns the class that has the highest priority. Now, there are 33 off-diagonal points. Here is a graphic of the mathematics that's used. That petal width for Statosa, petal width for versicolor, and petal width for Virginica are each displayed, and when a new petal width comes in, it's measured, and the result that it's given is determined by which is most likely based on the probability density function. Nearest neighbor analysis just looks for what's close, and you'll see that in this case the model predicts classification areas that are not contiguous, that there are islands of one within the other. There are 13 off-diagonal results. If you're working with a neural network, the 4 inputs will be the sepal length and width, petal length and width. And those are the input layer for the neural network. There will be a hidden layer, the 2 nodes that are in the middle, and there will be an output layer for each of the possible classifications, Statosa, versicolor, or Virginica. One of the methods that was used early on for analysis of the iris data is discriminant analysis, and you'll notice in this case that the boundaries are curved, and there are 14 elements off the diagonal. The support vector machine is one that you will probably use quite a lot. If you want just a linear boundary, That's on the left, and if you are willing to or interested in having curved boundaries, you can use a polynomial, and that's shown on the right. The support vector machine attempts to maximize the margin distance between the two classes. And here's what several of the support vector machine models look like. There are two on the top that are linear, and they are straight lines, although not necessarily perpendicular to the axes. There's one on the left that's called a radial basis function, and there's one on the right that's called a third degree polynomial. So you'll see that the boundaries there can be curved as well. Support vector machine is very powerful. In this case, there were 14 that were misclassified. Now, there's very little that's published related to trading. Wes McKinney was an analyst with Cliff Asness in his hedge fund, and McKinney's book describes pandas. It's called Python for Data Analysis, and it's a critically important library. The pandas library is critically important to machine learning for trading. You need this book. Go to Amazon and buy a copy. Also, look at two videos. The first is by Vander Plas, an astronomer at the University of Washington, and the second is Wes McKinney. In both of these, you'll be impressed with the capabilities of Python and pandas to do data analysis. There are other websites listed, the scikit-learn documentation site, and pandas has its own website. The big issues as we're dealing with machine learning for trading, by far the biggest issue is understanding the data and preparing it for use by a machine learning algorithm. You're going to be spending about 80% of your time there. And you should be asking yourselves the question, what do you want to know, and what will you do when you know it? There is mathematics. The process is not automatic, and you need to think carefully about how you will trade the resulting system, assuming that it's accurate. Now, keep in mind that the 10,000 hour rule applies. That means that it's going to take 4 years full-time study and or experience with high-quality coaching to be good at this. You will need to make many choices, and you'll either make the choices or discover the choice from analyzing the data. One is the issue to trade, the second is the target. And one of the first issues you'll come up with is the threshold dividing the target into positive and negative categories. And you won't be able to do this other than looking at the risk normalized profit associated with the results. So there will be an iterative process. And what I'm referring to here is assume that you want to categorize some of the days as B long. You need to identify what percentage gain in the day ahead counts as B long. So is it anything above 0, or is it anything above 0.1%, and so forth. You'll need to work with predictor variables. You need to decide what they are and then pre-process them and transform them and align them. You need to pick a pivot date, and the pivot date is the starting date of the first out of sample period. By picking a pivot date for all of your analysis, all of your out of sample data will have the same period of calendar days in it. So you'll be able to easily compare one with another. You need to choose the in-sample length and the out-of-sample length, and you will note from my discussion of stationarity that the distribution of the model must be stationary over the sum of those two lengths, in-sample length plus out-of-sample length. And then you choose the machine learning algorithm, and that's a decision tree or a support vector machine or whichever. And those are relatively easy to swap in and out. So most of what you're doing is predictor variables, preprocessing, and transformation. The target is the time and analysis of action. For example, you're going to evaluate at the close of the day session, and you're going to be either long or flat from the current close to the next close. The important class will be labeled +1. That's the positive class, and in this case it is be long. And the other class is -1, and that is to be flat. Intermarket data is useful. Predictor variables can come from the change in price of the primary, from currency, from interest rate, from oil, from gold, broad market diffusion index, foreign markets, and so forth. What you will find is that all fast oscillators based on price of any given data series are essentially identical. As you look at RSI or position in range or commodity channel index and so forth, these are all the same. So just pick one. Pick an RSI or pick a detrended price oscillator and use it. You should avoid too many predictors. If RSI works well, and it does, you'd be tempted to add other indicators such as %B, CCI, and so forth. If you do that, the additional indicators should be both independent and predictive. And you will note that by using the mathematical technique called principal component analysis, that these other indicators applied to a single data series are so similar that only one of them is required. As you're doing pre-processing, and this is where most of your effort will be, make it easy for your model. Do not assume that the model can figure out the patterns by itself. And present the data that is likely to be a component of a pattern. Beware of p greater than n. N is the number of data points in a time period. For example, 252 daily data points if you're using mark-to-market accounting. P is the number of combinations of parameter values used to fit the rules to the data. If you've got more columns than rows, you essentially guarantee that you have an overfit model. It will fit perfectly, or at least very well, during learning, and with no guarantee that it's going to fit well during out-of-sample testing. One of the things that you'll be doing for transformation is going from raw data to some indicator crosses zero in some way. For your target, you're going from be long to be flat. You're going from +1 to -1, and that counts as a zero crossing. Count the number of zero crossings of your target in a period of time, say a year. In order to be useful, the predictor variable should have about the same number of zero crossings. And depending on the machine learning model, you can do either no transformation, such as the tree structure, or you can transform to zero mean, typically with unit standard deviation, such as a z-score or softmax, or you can transform into the range from 0 to 1, for example using %rank. Neural networks want 0 to 1. Support vector machines want zero mean unit standard deviation. Decision trees don't really care. So depending on your machine learning model, you may be doing different transformations. The data, as seen from the perspective of a trading system development platform, is a row for each day, and it's possible for the values of previous days to be referred to in a single statement. So if I'm looking at a drop of RSI from a high number to a low number to indicate a buy signal, I can refer to both the current value of the RSI and the previous value of the RSI in a single statement. That the reference to prior data is handled by the development platform. The data from the perspective of machine learning is different. Each row needs to be independent, and each row is going to be a day, but if I want to refer to the RSI of a previous day, I need to have that as a variable in the row that I'm working with. So you'll see that we've got the same RSI today, RSI yesterday, and so forth. But in this case, we're referring to them horizontally rather than vertically. An ideal indicator looks like this. What we're trying to do is separate the gains, and that's the distance above or below the horizontal line in the middle, into gains that are positive and gains that are negative, so that we can only trade those days where the gain ahead is positive. The way we do that using a traditional trading system development platform is by computing an indicator and drawing a line vertically. So we're trying to divide the target space horizontally using a vertical barrier. If the ideal indicator looks like this, it's pretty easy. But the indicators and the data seldom have that clear relationship. So we've got a little bit fuzzy indicator here, and now if we try and draw the vertical line at the same point, an RSI of 50, we'll see that it doesn't eliminate all of the losing trades. If we move the vertical line to about 37, where it does eliminate all of the losing trades, we also give up some of the profitable trades. So there's some trade-off in setting the threshold. Again, we're trying to do a division of the target space horizontally by setting a vertical line. It's further complicated because this is what the data really looks like. And in order to resolve the conflicts, we need additional data. We need other data points. When we're evaluating the results of machine learning, this is the confusion matrix that is associated with trading. And you can see that predicting is either B long or B flat, and actually there's either a price rise or a price drop. And assuming for this hypothetical where we're looking at 252 days worth of activity, we've got 70 days predicted to be long and it did rise, and 96 days predicted to be flat and there was a drop. And those are correct, and we got 166 correct out of 252 days, or about 65%. Note that there are several days, 56 of them, when it was predicted to be flat but there was a rise, and that's a loss of opportunity. And there were 30 days when it was predicted to be a rise but there was a drop, and that's a loss of money. Look at this matrix in terms of columns. The machine learning model is going to be giving you B long and B flat. In the B long column, the true positive and the false positive are the days that you will be taking long positions. So you want the true positive to be a big number and the false positive to be a small number. And this is the relationship between the confusion matrix and the indicator. And these sections of the chart relate exactly to the squares in the confusion matrix. True positive and false positive are on the left. When the system predicts B long, you're going to get one of the dots to the left of that vertical line at the threshold. Well, the real metric is risk-normalized compound annual rate of return. In order to compute that, we use the saved model to predict the state for the validation data, and then compute the gain or loss for those days predicted to be long. And using that data, we go through the risk normalization to compute SafeF and CAR25. This is a summary of the steps, and you'll note that many of them are the same as the trading system development platform. Input the price and volume, define a target, input intermarket data, and so forth. When you move the machine learning system to live trading, you will do this daily. You'll bring all the data up to current, align and clean the data, create and transform the indicators, creating the same quasi-independent elements that you used for training. And you will recall the previous trained and saved model and use it to predict targets. Evaluate SafeF and CAR25 in the dynamic position sizing technique that I've described, and take the signals. So does it work? These firms think it does, and they are hiring. And note, for example, the third one, David Shaw. Visit each of these websites, read about them, and look at their results. I used the machine learning techniques to predict B long or B flat for XLV, the S&P Select Sector Fund. And these are 3 out-of-sample equity curves. Here is the report of one of those. The in-sample period is 10 years from 2000 through 2009. The out-of-sample is 5 years, all of 2010, 11, 12, 13, and 14. And the terminal wealth of this particular run is 2.4, so the compound annual rate of return is 19.5%. To summarize, machine learning is an alternative to traditional trading system development. General tasks of model, learn, test, validate are unchanged. There are many more modeling algorithms available, and programming is done using a general-purpose language that has good support for mathematical operations, such as Python. The focus is on the target to be predicted, and you will be using state signals and mark-to-market daily management. Machine learning is used successfully by many of your competitors. The question I regularly get is this a black box? And that depends on your definition of black box to begin with. The A matrix contains the parameter values that define the model. Once it's defined, it's deterministic. And it depends on which model has been used whether the A matrix is easily understood, as it would be with a decision tree, or whether it's cryptic, as with a neural network. In any event, if you do consider it to be a black box, it's your black box. And I think this is really clever. What my friends think I do. Society thinks machine learning is working with the whole army of robots. My friends think I have a close relationship with one really attractive robot. My parents think that I'm working with racks and racks of high-powered computers. Other programmers think I'm solving esoteric mathematical equations. I think I'm designing a hyperplane to separate the target space. And what I really do is just call the support vector machine from the SciPy library. For more details, you can read the chapter in this book, Quantitative Technical Analysis, that's related to Introduction to Machine Learning. I have several other books, in particular Modeling Trading System Performance and Mean Reversion Trading Systems will be of interest to people who are following what we did here today. You can reach me at my email address, howard@blueowlpress.com. And if you are interested in having me work on a project of yours, you can reach me by telephone. That's the end of the presentation. This presentation is a separate recording. The presentation that was given live was broken up by some technical difficulties. There was one question asked during the live presentation that I want to address today. And the question was, can I compare the RS2 trading system that I used first with AmiBroker and then with Python, and that I discussed last month in the trading system development use of trading systems? And the answer is sort of. There is an RSI2 component in the equity curves and analysis that you saw in those 3 equity curves that were plotted. But keep in mind that in the indicator-based, we computed RSI first and then looked to see what happened. In machine learning, we first asked, do we want to be long tomorrow or short tomorrow, long tomorrow or flat tomorrow? And then we looked to see what happened earlier. So the predictor variables include RSI2, but the model is not focusing on RSI2. The model is focusing on the target. Well, thank you for your interest. I'm in the process of writing a book, which is a book-length expansion of the chapter on machine learning in the quantitative technical analysis book, and it is a book-length expansion of the presentation that you saw today. So keep in touch with my websites, and thank you very much. Goodbye.